Again, double-digit rate annualized. Part of the reason is consumption was not playing ball. And then you look at retail inventories in November, up 2%. That's month to month, annualized. Annualized, 24% plus. So this is something I don't think the headlines have captured. You might be surprised to hear it as well. Now, we have some other very interesting statistics. Imports in November were up 4.7%. Again, supply chains clearing up, the ships finally being cleared, not completely, but a lot faster. Did that go into inventories? They didn't make it into consumption, at least unless there was a barn burner of a December. And we do hear the credit card companies talking about strong sales, but they've been talking about strong sales for quite some time. The economic statistics, which are much broader based, are suggesting that that's some kind of overstatement or share shift, mix shift. Then we get to autos. I think this is the most fascinating part of what's going on in the economy right now. The Manheim Used Car Index has been screaming. I think the prices of used cars at their peak had increased on a year-over-year basis something like 60%. And that was adding to the CPI. Well, very interestingly, we've had a few reports now that suggest that the bubble was in used cars and that it might be bursting. We can see this a few ways. On a year-over-year basis now, used car sales units are falling. They're down 4%. November to December, they were flat, but year-over-year, that was down 4%. We're seeing prices finally start to fall. They were down 1.2% month to month. Again, annual, that's a big decrease month to month. Annualized, roughly 12%. On a year-over-year basis, they're still up 46%, but they have started to fall. And what tells us that they will continue to fall, and mind you, they've had a disproportionate impact on the CPI. What tells us they will continue to fall is now an inventory buildup in the used car space. Normal inventories for used cars are, I believe, 43 days. Now they are at 54 days. So well above average. And I believe at their lows, they were in the 20-day supply range. Now, many people are looking at the hike in used car prices, and they've probably been thinking about selling that car and that extra car maybe that they bought to avoid mass transit during the coronavirus. If they see prices coming down, they probably will move a little more quickly. And then on the wholesale front, this Manheim Index says that inventory levels typically are 23 days. Now they are 33 days. So that's interesting on the used car front. On the new car front, fascinating. At an annual rate here in the United States, new auto sales peaked in April at 18.25 million units. Now, when we got to October and the auto OEMs were talking on earnings reports, each one of them, including Elon Musk, was saying, okay, the chip shortage is beginning to alleviate. Now, they had been blaming the decline in sales because it started in April, and it was declined to 13 million units from 18 and a quarter. That 13 is an October number. Chips were the missing link. Okay, they're starting to be replenished. November, 12.86. December, we just got this number, 12.44. Meanwhile, you've got electric vehicle sales up nearly 100% at an annual rate. What's going on here? Well, it could be a combination of consumer sentiment consumer not being happy about what's going on, and a consumer preference shift towards electric vehicles. That is why at the CES show, the Consumer Electronics Show, you heard these auto OEMs talking more about electric vehicles. Of course, it was the electronics show. And we saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand. Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now. If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend, they're going to spend on electric, then these OEMs have an issue. They have a problem. And we think we're going to hear more about it in the quarterly reports. And we hope analysts start asking about it. Now, I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric. But the problem is almost 100% of their base is going to go obsolete over time. So very, very interesting there.